Hey everyone, welcome back to Corporate Decoder, the place where we uncover the real stories hiding in plain sight within corporate financial reports. This week, we're diving deep into the latest annual shareholder report from Columbia Ultra Short-Term Bond Fund. Get ready because this filing is packed with more numbers than a dial-up modem trying to download high-def video, and we'll tell you what it all means for investors. If you're new here, you know the drill. We break down complex financial documents into plain English, so you can understand what is happening behind the scenes. Before we jump in, if you appreciate getting straight insights from these filings, please hit that subscribe button. And if you want to connect with other finance enthusiasts and dive deeper into these topics, join our Discord community linked in the description below. So, what is the big picture here? We're relooking at a report for the period ending the 31st of July 2025 for the Columbia Ultra Short-Term Bond Fund. This fund is basically a way for people to invest in a big collection of short-term bonds. Think of it like a very safe, very conservative investment pool. The report comes to us from Columbia Funds Series Trust I, and it is a certified shareholder report, which means it is official and packed with data. The report categorizes its performance into sections like management, discussion of fund performance. Here they talk about what made the fund do well and what held it back. They mention that things like asset-backed securities and investment-grade corporate bonds were good for performance. They also note that being underweight in the very front end of the yield curve hurt them a bit, especially with the Federal Reserve cutting rates 3 times in late 2024. This is all pretty standard stuff for a bond fund. They trying to navigate interest rate changes and credit markets. Now, let's talk money. The fund net assets as of the 31st of July 2025 are a massive $1,229,750,696. That is over $1 billion. This tells us there is a lot of money being managed here, and so the decisions made by the fund managers have a big impact. But what is all that money invested in? This is where it gets interesting. The portfolio of investments is a deep dive into what the fund actually owns. A huge chunk, 33.2%, is in asset-backed securities. These are basically bundles of loans that are sliced up and sold. We're seeing things like Ford Credit Auto Lease Trust, CarMax Auto Owner Trust, and various other auto and equipment financing trusts. These are all tied to consumer debt. Think car loans, credit card receivables, that sort of thing. The fund holds millions of dollars in these. For example, they have over $20 million in Ford Credit Auto Lease Trust with a coupon rate of 5.060%. Another big slice, 46.2%, is in corporate bonds and notes. This is where companies borrow money to fund their operations. We see them invested in big names like Bank of America, Morgan Chase, Verizon, and AT&T. They hold significant amounts like $160 million in banking sector corporate bonds alone. For instance, they have $12 million in Morgan Chase and company bonds with a coupon of 5.571%. Then there are residential mortgage-backed securities making up 10.7%. These are backed by mortgages. Importantly, non-agency means they aren't directly guaranteed by the government, so there is a bit more credit risk involved. They are holding things like Connecticut Avenue Securities Trust and Freddie Mac Stacker Remick Trust. Let's look at performance metrics for class of shares. The net asset value at the beginning of the period was $9.24 and it ended at $9.26. That is a small increase. The total return for class of shares for the year was 5.07%. The report compares this to returns from the Bloomberg US Short Term Government Corporate Index, which returned 4.72%, and the Bloomberg US Aggregate Bond Index, which returned 3.38%. So, the fund slightly outperformed its short-term benchmark, which is good, but it underperformed the broader Aggregate Bond Index. Now, let's talk about costs. For class of shares, the total net expense ratio after waivers was 0.45%. That might sound small, but on over $1 billion it adds up. For institutional class shares, it was 0.30%, and for institutional 3 class, it was 0.24%. Lower fees are always better for investors. The main fee here is the management services fee, which is $2,323,663. This represents 0.21% of the fund's average net assets, which aligns with the expense ratios we see. Looking at the statement of operations, we see that net investment income for the year was $52,306,092. This is the money earned from interest payments and dividends, minus the fund's expenses. The fund also had a net realized and unrealized gain of $3,477,345. This comes from selling investments for more than they paid and from the increase in value of investments still held. All of this together resulted in a net increase in net assets of $55,783,437 for the year. They talk about fair value measurements and break them down into level 1, level 2, and level 3. Level 1 is for investments in active markets with quoted prices. Level 2 uses other observable inputs, and level 3 relies on significant unobservable inputs, meaning management has to make more assumptions. Most of their investments, over $1.2 billion worth, are in level 2. This suggests they are mostly holding fairly valued, albeit not always actively traded, securities. The report also includes the auditor's opinion. PricewaterhouseCoopers LLP gives a clean opinion, stating that the financial statements present fairly in all material respects the financial position and results of the fund. This is what you want to see, an unqualified opinion from a reputable accounting firm. A notable risk mentioned is shareholder concentration risk. At the 31st of July 2025, affiliated shareholders owned a whopping 60.8% of the fund as shares. This means a large chunk of the fund S ownership is tied to related entities. A big redemption from these insiders could force the fund to sell assets at a bad time. This is a significant concentration and something to keep an eye on. So, my take on this filing, the Columbia Ultra Short-Term Bond Fund is a massive, well-established fund. They re-operating in a stable part of the market, focused on managing short-term interest rate risk and credit quality within bonds and asset-backed securities. Their performance for the year was solid, slightly beating their benchmark, but not dramatically. The expenses are relatively low, especially for the institutional classes, which is a positive. However, the significant shareholder concentration is a red flag worth noting. While the fund is large insider ownership, that high could create unique dynamics and potential risks if those insiders decide to pull out a large amount of money. The fund holds a lot of asset-backed and corporate debt, so understanding the credit quality of those underlying assets is always key, though they do appear to be focused on investment grade and fairly liquid instruments for the most part. Overall, it seems like a steady ship. They are navigating the bond market competently, but that concentrated ownership introduces an element of risk that investors should be aware of. That is our deep dive into the Columbia Ultra Short-Term Bond Fund, S Annual Report. What is your take on these numbers and what they signal for the company, S Future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. And as always, check out the Discord link in the description for more discussion. Thanks for watching. See you next time. youtube.com/corporatedecoder.